In today's video, we're talking about something that doesn't normally get a lot of attention, tariffs, and how they can actually drive up the cost of car insurance for businesses with fleets or for employees who get reimbursed for using their personal cars. I know tariffs and insurance, it doesn't sound super thrilling at first, but stick around because this stuff affects prices we pay every single day. So trust me, you'll want to know what's going on. First things first, what is a tariff? A tariff is basically a tax the government puts on imports, things like parts made outside of the country. The idea is to encourage people to buy local or domestic goods by making foreign products more expensive. But as we'll see, tariffs can also raise costs in ways you might not expect. When there's a tariff on imported cars, trucks, or car parts, everyone in the supply chain can end up bearing some of those costs. So let's break it down. If car parts get taxed more, the price to fix the car jumps. If new cars or trucks cost more, you have higher car payments. And guess what? What happens to car insurance if your car is now more expensive? Exactly what you think. You end up paying more to insure it. So how does this affect insurance? Well, insurance is all about risk and costs. If tariffs make it cost more money for insurers to fix or replace a vehicle after an accident, they're going to charge higher insurance premiums. So when tariffs make car parts more expensive or raise the cost of new vehicles, insurance companies have to pay more for claims. They then pass that cost along to businesses and drivers. So if you have sales reps or technicians on your payroll and your cars are imported, or if they happen to have key components shipped in from abroad, tariffs can seriously bump up your regular repair bills. Insurance companies watch that stuff like a hawk. So the next time you renew, you might notice that your premium is a little higher or a lot higher than it previously was. Not everyone drives a company-owned car. Plenty of folks use their personal cars for work and get reimbursed for the cost. One popular setup is FAVR, or fixed and variable rate, where fixed equals predictable ownership costs, insurance, registration, taxes, and variable equals per mile stuff like fuel, maintenance, tires, wear and tear. How do tariffs fit in? Well, tariffs can nudge costs up, but mostly for new vehicles and day-to-day maintenance. New car prices and new parts may rise, yet the exact percentage is still a moving target as policies shift. Fixed reimbursements don't automatically have to spike. A company can base its favor profile on a 2025 vehicle that's mostly American made, or even keep an earlier model year in the profile as long as it's still inside the normal retention cycle. Letting employees drive slightly older cars can keep everyone compliant and hold fixed costs pretty steady. If maintenance or repair prices creep up because imported parts cost more, the cents per mile portion can flex a bit to cover. No need to overhaul the whole plan. Ultimately, reimbursements give you control. Compared with owning a fleet, a favor program lets companies fine-tune allowances when challenges pop up. Think part shortages or procurement delays without committing to a blanket premium increase. So while tariffs might push some costs north, a well-managed favor plan offers levers to keep budgets and employees on track, instead of forcing an across-the-board rate hike right now. We've seen some numbers suggesting that tariffs can push car insurance rates up a lot faster than normal. Like, instead of a 5% yearly jump, we might see rates rise closer to 10 or even higher if there are big tariffs on steel or auto parts. Over time, that can really add up, especially if you're running a bunch of vehicles. This isn't the first time tariffs have hit the auto industry. Back in 2018, there were tariffs on steel and aluminum that raised production costs, and we saw insurance rates begin to climb. But tariffs aren't just one part of the story. Things like inflation and new technology in cars can also hike up repair costs. So why should you care? You might be thinking, well, if my company pays for the fleet, why should I worry? But higher operating costs can often get passed on to customers or employees in the form of increased fees or benefits adjustments. So what can you do? You can stay safe on the road. Fewer accidents mean fewer insurance claims, which can help control premium hikes over time. and keep an eye on legislation. If new tariffs pop up, try to understand that it can affect far more than just the sticker price on a new car. So there you have it. Tariffs can sneakily raise the cost of your business's commercial fleet insurance. It's all interconnected: global trade, local repair shops, insurance companies, and our wallets. If you found this video helpful, or if you think your boss or coworkers need to know about rising insurance costs, share this video, drop a question or personal experience in the comments section. I'd love to hear from you. And if you haven't yet, make sure to subscribe and hit that notification bell so that you never miss an update or a video. So thanks for hanging out. Stay safe out there, and we'll catch you in the next video.